Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending. And joining me today, well, I think he's the smartest guy in the room, but he's going to be challenged by two other smart guys in our podcast. We'll get to that in a second, but I'd like to welcome Mr. Michael Becker.
Good thing I'm in the room by myself, so that works out today.
Are you still quarantined, Mike?
April 22nd, so we're somewhere towards the end of week 6, quarantined here.
That's a long time to be quarantined, but I'm in the same boat with you, like our guests too. So I think today on our podcast, this is a little bit of sharpening our skills when borrowing money. Let's put it under that header. We brought in JP Conklin into the podcast again. And JP, if you've listened to some of the stuff before, he is with Pensford Financial Group. And what they do is they know everything about interest rates. And so JP wrote a newsletter that came out last week or this week that we thought was pretty good. And so we assembled JP to join us. Michael Becker's with us today. And then the professor himself, because we needed the third smart guy in the room, James Eng is with us too. So James, welcome to the podcast. JP, welcome to the podcast. And Mr. Michael Becker, welcome to your own podcast. We appreciate that. So let's talk a little bit about the newsletter. And let me see if I can start it off this way. What was 2.48 last year? What was 0.92 last month? And what is 0.79 today? And I'll let Michael, you take it from there.
Well, you're wrong because it's 0.57 today. That'd be 30-day LIBOR. So
that's right.
30-day LIBOR is starting to slow decline, and that's really what the newsletter talked about, or one of the things it talked about. So if you guys haven't signed up for it, just go to Pensford.com. It's a Pensford letter that JP writes seemingly every weekend that comes out on Monday morning. So JP, welcome to the podcast. Thanks so much for joining us again.
Yeah, thanks for having me.
Yeah, cool. So maybe what I thought we can do is kind of maybe just talk about, really, you hit two things on there, which was one of the things I've been wondering about for a while, because we have quite a bit of floating rate debt, is why was when everything was falling apart a month ago, SOFR went down to 1 basis point and LIBOR was hanging around 1%. So it was, 100 times greater. And I always thought that LIBOR should kind of track along with SOFR, and they were disparate from each other. And I was just trying to figure out why that was. And it looks like they're still starting to slow, steady decline and LIBOR, and kind of where do we see it going? So maybe you kind of talk a little bit about LIBOR, what it is, and why it diverged, and kind of where it's going.
Sure. So LIBOR historically tracks Fed funds, and the Fed controls short-term floating rates through Fed funds, and LIBOR is one of those indexes that's highly correlated to it. And so when they want to lower interest rates to kind of spur the economy, LIBOR moves down with it. LIBOR stands for London Interbank Offered Rate, and it's really an unsecured rate between financial institutions. So you think of like the Wells Fargo borrowing money from a Bank of America, it would generally be charged at LIBOR, but it's unsecured. And so during periods of financial stress, you tend to see LIBOR disconnect from that historical relationship. Normally, LIBOR is about 15 basis points over Fed funds. But during periods of financial stress, like the one that we're in right now, it disconnects, and it ends up being artificially high relative to where it should be and where the Fed wants it to be. So if you go back to the financial crisis, when banks were actually going under, banks didn't trust each other. They were afraid that they weren't going to get their money back if they loaned to each other. And so how do you incentivize someone to lend to you? You agree to pay a higher interest rate. And so LIBOR actually climbed 380 basis points over Fed funds. And there was quite a few banks like Wachovia, the one that I worked at, who couldn't get a loan from another bank no matter what they offered to pay, because banks were just afraid they were not going to be repaid, because, again, it was unsecured. So what we're seeing today is the Fed cut interest rates to 0 a month ago, but there's too much financial stress for LIBOR to catch up immediately. And so as that financial stress starts to settle and dissipate, LIBOR will start gradually moving down. So as you just pointed out, it reset this morning at about 57 basis points. We would expect that to continue to head lower over the next probably month or two, and eventually settle into somewhere around 15 to 20 basis points, where it will presumably be for the next couple of years until the Fed starts to hike interest rates again.
So yeah, that to your point from anecdotal story was, when I was a banker 12 years ago, and everyone wanted on their adjustable or floating rate mortgages, every one of our clients wanted LIBOR, and then one day versus prime. Then one day I got about 5 phone calls from everyone that was on LIBOR asking to be switched their index to prime because LIBOR dislocated quite a bit and historically was materially below prime. Like, today prime's 3.25 and LIBOR is 57 bips. And, it was the inverse of that 12 years ago where LIBOR was materially higher than prime for about a 3 or 4 month period before it settled down. So that was, interesting to kind of hear a little bit of backstory to what I experienced, a decade or better ago. So if I have, which I do, if I have a couple, tens of millions of dollars of floating rate mortgages that I have not bought a LIBOR cap on, when would you say would be the best time to buy a LIBOR cap in the near term? Would that be today or in 2-3 months from now, or does it really matter because the caps are pricing in future expectations of where LIBOR is going to be?
Yeah, that's a great question. I think the volatility is probably still a little bit elevated relative to where it should be, just given how crazy the headlines are every single day. But there's no doubt that we are close to the bottom in terms of interest rate cap pricing. So anybody who would be looking to buy an interest rate cap today is already receiving the benefit of the market expecting LIBOR to settle down. So even though LIBOR is at 57 today, the market's already got resets in the next couple of months with LIBOR down around 15. And at one point, even over the summer, it's actually negative. And so holding off won't necessarily translate into lower cap pricing just because today's LIBOR goes from 57 to 15. What could be beneficial is overall volatility starts to settle down. And as LIBOR drifts lower, the cap pricing drifts lower because volatility is dissipating, not just because LIBOR went from 57 to 15.
Got it. And how much cheaper is cap pricing today versus, say, a year or two ago from, kind of a similar size loan? Is everything in, 50% or greater, or where's kind of the pricing on caps? Because it seems like market expects it, like you're saying, to go to next to nothing and stay there for a very long period of time.
Caps are getting back to the level that they cost between 2012 and 2015 when they were effectively free from the market standpoint. Banks that sell you caps will still have transaction costs, but there is really no economic value to a cap. If you bought a cap today at 2% for 3 years, the market's not really charging you anything for that because there's almost no probability that it will pay off. And if you go back to 2012, in the summer of 2012, the Fed said, we are not hiking interest rates until at least mid-2015. And so short-term rates collapsed down to just over zero and were anchored there for 3 years. And so caps at that time were basically free. Caps were like 10 grand. It almost didn't matter how big it was. It was just more about the transaction cost. We aren't quite there yet, but we're close. And so cap prices have dropped precipitously over the last couple of months. And with the Fed making it clear that they're on hold for the foreseeable future, I would expect cap prices to be low for a while.
So anyone that has a LIBOR-based floater is going to be looking good for the foreseeable future?
Barring another flare-up in financial stress. So if we saw something that came back that took us back to sort of the stress or volatility we were experiencing starting 4 weeks ago, LIBOR could dislocate again. But it's unlikely it's going to dislocate to 3%. And even if you were trying to hedge that and you bought a cap to protect against that scenario, when you look back at the financial crisis, even though banks were literally going under, it only dislocated for 3 months. It's not like it lasted for years. So I think if you're buying a cap right now, you're probably buying a much lower strike than you're accustomed to, and you're doing it to be taking advantage of how cheap they are. So we have a lot more clients today buying caps with strikes below 1% or with terms longer than 3 years. That sort of used to be the sweet spot, 3 years or less for interest rate caps. We're seeing far more 5 to 10 year caps in this environment because people are afraid that inflation will eventually rear its ugly head at some point down the road. And if I could take advantage of buying a cap when rates are sub 1%, let me do it. And then when everything rebounds, I already have that protection in place.
Hey, JP, this is James. In your newsletter, you also talked about a couple things. One is sort of what drives long-term interest rates, which I want you to get into, but then also, a lot of deals right now that people are fixing rates, let's say on Fannie Mae at 3.5 on a 10-year is all driven off the 10-year Treasury. And maybe talk about where 10-year Treasury is today, but then also, how the Fed and Treasury sort of work in the 10-year Treasury market right now.
Sure. So the 10-year Treasury had dropped below 1% starting probably about 6 weeks ago. And now we're trading at right around 61 basis points, which is about 5 basis points, 6 basis points over the all-time low at close. And so we're basically at all-time lows currently. The Federal Reserve in January was trying to address this concern before any of this happened, address the concern that they did not have sufficient ammunition to fend off the next recession. And one of the things that they said that they could do was to put a cap on Treasury yields. And so, for example, they didn't cite this, but just conceptually, maybe they don't want the 10-year Treasury yield to be above 1%. And the example is Japan. Japan has been doing that for about 3 years. They've anchored their 10-year bond at 0%. They've just set it at 0%, which provides stability and the ability for projecting what your costs are going to be for the foreseeable future. And the Fed said, we can do the same thing in the next downturn. So fast forward a few months, here we are, clearly in the next downturn. And it makes me think that they are not going to allow the 10-year Treasury to run up dramatically anytime soon, that they will continue to make sure that interest rates stay below a certain level in order to encourage growth. Now, one of the things that you're touching on is, hey, that's great, but the Treasury is issuing the biggest amount of Treasury bonds and notes in history. We're going to issue over $1 trillion in Treasury issuance this quarter, which is just a staggering amount. Wouldn't that suggest that rates have to rise? And the answer is, in a vacuum, yes. But the Fed is buying up nearly all of those issuances. So the Treasury issues the bonds, and then the Fed is the first buyer. And whatever the Fed doesn't buy is left over for everybody else. And by restricting the supply that's really hitting the open market, there's overwhelming demand. We are still the world's mattress. So we are at no risk that demand for 10-year Treasuries, for example, is about to run out because people are sticking their money under the mattress, and the United States is the safest mattress, and our 10-year Treasury is the benchmark. And so what I expect we see most of 2020 is the Federal Reserve will continue to buy up most of the Treasury issuance that is done in order to create this stimulus to try to prop up the economy.
So everything you've said is lower interest rates. So what's going to eventually, there's been the CARES Act, which is 2.2 trillion, there was another 2.3 trillion, it seems like another 500 billion that came out yesterday. I guess at what point, what's going to drive sort of interest rates up long term? Are we here for a long time?
I suspect that we're here for a long time. The sort of things that generally drive interest rates higher are economic growth and inflation. And economic growth is no longer just United States economic growth. This is a global game. So it is challenging for the United States 10-year Treasury to run up to 3% when something like the German Bund is in negative territory. So global yields are keeping a lid on our yields and have been for several years. So even if we return to a point where we see growth picking back up, it doesn't necessarily imply that the 10-year Treasury is going to spike. That being said, if we do see an opening of the economy and sort of a revamping of our economic structure over the next couple of years, the risk to me of higher rates comes from a couple things, and that would be a combination of GDP and concerns about inflation, whether or not inflation is present at that time, more about expectations of inflation. And so let's say we have some crazy V-shaped recovery a year from now and GDP is 15% one quarter. That's the sort of thing that could cause a pop in the 10-year treasuries, especially if it's coupled with some sort of fear about inflation. I think the other big risk out there right now is this Fed balance sheet is going to balloon. Before the financial crisis, Fed basically had no balance sheet holding treasuries. And then during that, it ran up to 4.5 trillion. They started to unwind during balance sheet normalization, and the economy toppled. And so now they're up to 6 trillion already, and it looks like we're headed to 10 trillion in short order. Any sort of misstep, mishandling of that unwinding by the Fed could cause a pop in rates because they will be far and away the biggest holder of U.S. treasuries. I always hear clients ask about, is China going to start dumping treasuries? China's irrelevant in the grand scheme of things relative to our Fed. I would be far more worried about the Fed making a misstep, probably not a conscious decision to actively sell treasuries because it would spook the market, but just a mishandling or missignaling that would cause sort of like what we saw in the taper tantrum of 2013, where the 10-year treasury spikes more than a point in 4 weeks. But I think that all of that is pretty far out. And in the near term, we're far more worried about low rates, negative rates, and deflation than we are worried about growth and inflation and a 5% 10-year treasury.
Do you see consumer price inflation ever coming in? And what about obviously the last 12 years, they printed a bunch of money from where we were kind of going into 2008, and the Fed monetized a bunch of debt, and we saw little to no consumer price inflation, but asset price inflation, like a lot of people obviously listen to this podcast are into multifamily investments, and from the bottom of the cycle to kind of where we peaked out a month or two ago, seemingly rents in Texas have doubled and prices tripled for multifamily. So there's quite a bit of asset price inflation. Do you envision either consumer price or asset price inflation to continue to go up? Because looking at the stock market, it doesn't make any logical sense to me. Short of it's only going up by the amount the Fed is expanding its balance sheet, seemingly.
Yeah, I agree 100% that we will continue to see asset price inflation as long as the Federal Reserve is propping things up and as long as we are just accommodating at all costs. So I think we'll continue to see that. I can't explain why S&P is trading at 2,800 or the Dow is over 23,000. It's nonsensical relative to the sort of economic conditions we're in. It is strictly related to Fed intervention. I don't see any near term, especially consumer inflation. Like you said, we went a decade without seeing that. I don't know why we would see that anytime soon. And I have a feeling that 50 years from now, when we're writing economic books, looking back on this time, we're just going to realize that we kept expecting inflation to hit a level that it no longer was going to get to. That we have some sort of new structure around inflation that the old models no longer apply to. And 2% might not be the number anymore. It might be sub 1% as the new normal, and we should adjust accordingly. And people throw out a million different reasons, such as technology or Amazon, things of that nature. I think it's all of that is coupling to keep inflation relatively low in the grand scheme of things. And I just don't see that changing anytime soon with this downturn.
Even with the talk of the onshoring of jobs and going from the most efficient economy, supply chain to a little bit more resilient supply chains. It seems like we're all learning through this. Our supply chain was extremely efficient 2-3 months ago, but it wasn't very resilient. So shocks like this are, going to cause maybe some supply issues across, or less of fear at least. We're going to see a lot of supply issues for a lot of everyday goods and consumer staples and appliances and all the various things that are made in China. And then as we start ramping up production in America at a much higher salaries, you would think that we would see some level of price inflation from everyday goods. Do you still think with all the jiggering that the Fed's doing is going to kind of keep all that down?
Yep. I think I have wondered about inflation for 10 years now, and it's just not here. And I'm just starting to think that it's no longer the way that it used to be. And we don't know exactly why, but it's just a new normal. So everything you just said to me is totally logical. But I've had similar arguments about other topics regarding inflation over the last 10 years, and yet it never comes to pass. So to me, it's like, yes, there is always that risk that is going to pop back up. But we just haven't seen it, and I don't see it any time in the near term because consumers will not be spending money on anything other than food for the foreseeable future. So to me, none of this is relevant until we have a vaccine or until so much of the population is recovered and basically immune going forward that consumer behavior returns to normal. We have experienced a psychological break in consumer spending that is probably going to take at least a year plus in order to get back to previous levels.
Hey, JP, I guess this might be coming out on your next newsletter, but oil, we're here in Texas, and oil just took a dive this past couple of days. Any comments on how that impacts? I mean, I think gas is like $1 a gallon if you go fill up right now. So any comments on how that's going to impact all this, or is this just like the second black swan after the coronavirus to hit the economy?
Yeah, just piling on when everything is already horrible. Usually a moderate or a measured decline in commodity prices is usually almost like a stimulus package for the average consumer, right? When you can fill up at $1 a gallon instead of $2 a gallon, that's extra money in your pocket. But when we have a total collapse, it tends to send shockwaves through the economy and very frequently could lead to its own severe recession all by itself. And here it is coupled with all these other issues that we have going on. So I suspect that this will just be a contributing factor to the severity of this downturn. And then we are just going to see dramatic GDP contraction this quarter, likely next quarter, and then maybe even Q4 as well.
When you make up an interest rate, the interest rate is made up of spread and an index. And we just talked about the index. With groups not paying their mortgages these days, we're going to see a lot of defaults in the commercial sector of the CMBS and some of these banks. What do you see for spreads rising in the near future?
My expectation is that spreads will stay elevated, mostly out of uncertainty. And then over time, that will gradually become more targeted. And so for the guys down in Texas who have an office building, it may have different pricing than somebody who is in a different part of the country in a different asset class, as we see lenders adjust to those specifics. You know, right now it's kind of blanket. It's industry-wide. Everything is wider. Over time, let's say that multifamily comes back quickest, I would expect to see Fannie and Freddie spreads to decrease before a Wells Fargo spread on, Class B office in Houston would come back. But for right now, our approach as a lender, our approach is basically the same approach that the country is taking to coronavirus, which is blanket. It's just non-precision, non-targeted. Everything's gapped out wider, and then we will figure all this out 3 months from now when we have a little bit more information.
I know you're short on time here, so kind of as we wrap up, JP, where do you see commercial real estate or multifamily / industrial seem like they're going to be the two winners coming out of this, and retail, hospitality are obviously going to be, in the least favored nation status for many years, I would imagine, and then office probably somewhere in the middle. Where do you see asset pricing for industrial and multifamily, 5 years, 6, 7 years down? Are we going to be materially higher, or do you think we're going to be in a lull for a little while?
Well, the 5 years is a long time. My crystal ball is usually only good for about 15 minutes. But I would say that my expectation is 5 years is long enough to experience a rebound. And, I'm a little bit of a contrarian. So, to me, this shutdown doesn't mean that we all start working from home now permanently. It's going to be a resurgence in office demand because we all realize how much we hate working from home. And so I think that office is actually going to rebound at some point, once we get some sort of vaccine. But my suspicion is everything will be higher in large part because the Fed is all in. Worst case scenario, the Fed is still all in. They are not going to allow a total epic collapse of this economy. And therefore, that will create liquidity, which in turn will drive up asset prices.
If people wanted to get your newsletter, JP, what's the best way of them taking a look at your newsletter and listen to your fantastic podcast now?
Yeah, just come to our website, pensford.com, PENSFORD, and you can sign up right there.
That's fantastic. So we definitely appreciate JP being on the podcast. We're going to let him go. Mike and James, can you stay on and let's just continue the conversation a little bit?
Yeah, thanks, JP. Appreciate it.
Thank you, guys. Have a good one.
All right. So as JP goes away, Mike, what's your overall take on where interest rates are at today and where are they going to go?
It seems like we're low and going to stay low from everything he could say for the near and intermediate term. And then, long term, I got to think that we start seeing some level of asset price inflation, just due to the amount of liquidity they're dumping in the market. And there was already a ton of capital chasing stuff from the previous 12 years of monetary policy, or really 20 years of monetary policy. That's just a bunch of capital slushing around trying to find a home. And, I think industrial and multifamily certainly will further benefit from the disproportionate amount of capital flow into it, because as people move away from hospitality and retail and they still want to have exposure to the commercial real estate market, I think they'll just further double down on multifamily, industrial, and like I said, I think office will probably be somewhere in the middle. So I think, if we can hang on the next, 12 months, right? So we hang on through March of next year, I think, in 10 years from now, asset prices are going to be substantially higher, simply just due to the amount of liquidity that's going to be injected, has been and will continue to be injected in the market. And it seems like they keep compounding their problems, and they talk about income inequality and disparity and from the rich to the poor, and all their policies just further benefit the rich, because the Fed is the problem, I think, at the end of the day, and they're pumping money. So not to be a paranoid libertarian on you, Paul, but that's what I think is about to happen.
And then James, are you seeing any rescue funds get put together or opportunity funds get together? A lot of people have had some time in this last, say, 3 or 4 weeks, and just kind of seeing maybe there's going to be a number of partnerships that are going to have problems, or there's a lot of groups that own real estate right now that may not be able to make their debt service. What are you starting to hear groups come up, and what do you think about that?
Yeah, I think the challenges that I've seen is if somebody was limping into April already, so maybe their property was at 80% occupancy already, they're in trouble. And because they collected 20% or they have 20% delinquency on that 80%, so they're 60% collected versus a normal property, and they're running into trouble. They're going to probably request forbearance, but then they're probably over levered as well. And so that's if you're a combination of underoccupied and over levered, you're in trouble. And so what we're seeing is, unfortunately, the last quote I got on a Fannie deal was like 3.25. Unfortunately, nobody really is doing new debt from Fannie and Freddie, so the quote sheets look great, but nobody's really taking advantage of low rates right now, and you're having to assume debt that is 4.5% to 5% on most deals.
Why are they not pursuing new Fannie and Freddie with rates so low?
Well, there's a couple things. Most multifamily owners have existing Fannie and Freddie debt on their property already, and a lot of times, let's just use an easy example. Let's say there's an $8 million loan on the property already, and you can come in and buy that deal for $9 million or $9.5 million. And essentially you're getting, 85-90% leverage on the deal coming in and assuming that existing loan. And that seller can walk away without paying a prepay. So instead of coming in and trying to do new debt, which would be max 75% leverage with 12 to 18 months of P&I reserve and taxes and insurance and replacement reserve, 12 months of that escrow, they're having to just assume the loan. And so you come in, put the equity down to assume the loan. But even though you're not required to put the 12 months, almost every buyer that I'm talking to I'm telling them you probably need 12 to 24 months of interest reserve, potentially tax and insurance reserve, just that you raise, because this is very different than 3 to 6 months ago where you came in and it was 95% occupied and cash flow day one. All these deals that you're going to buy in the next 12 months are going to be broken. And so when you come in, you're going to have a longer time frame, right? So most of these Fannie loans still have 8 years or 10 years left on the deal. But in the next 12 months, your cash flow might be zero.
What's the confidence level for a lot of these syndicators to raise capital these days? Is it an easy time? Is it a hard time? Where is it these days?
I would say it's in the middle. And I think for more experienced indicators, it's going to be easier, and especially for a dislocated price. So essentially, if you're buying a deal that was, 4 years ago pricing based on the loan assumption, and you're having to only bring in $1 million in equity up front, I think the story's there. And then if you can show that, you have a deal around the corner that is 90%, 95% occupied, but this is just mismanaged, I think that's a better story than coming into a new market and trying to buy a deal that is broken. And, in those Trammell Crow papers that I read, if you try to bottom fish and you don't have enough capital, you become the fish. So make sure you have enough capital up front on these deals. And I would probably be on the more conservative side.
You become the bait.
You become the bait. So someone else is going to come in and swallow you.
And we're talking about deals like they're actually happening. And what I can tell, and from our conversation recently we had with Jacob Anderson from Newmark, there is no transactions really of note happening. It's kind of a whole lot of nothing, and we're all just kind of waiting for something to finally break. And here we're towards the end of April. I mean, I gotta think it's third quarter before we see the first trickle of it to come on, and then it'll probably take a little while from that point. So I think we're all just kind of sitting here doing nothing for the foreseeable future. And James, I did have a question for you, kind of talking about the money that the Fannie and Freddie are making you put up for the 12 months of principal, interest, taxes, and insurance reserves as escrow. What is the mechanism of actually getting that money out? So I know that if you don't need it, you kind of, one, have to be out of the state of emergency in your local area, and then two, have to have a certain debt coverage test for a quarter or two consecutive quarters to get it released. But what if you have deficit cash flow and you need access to money? Do they then ferret that out, or is that just additional collateral for them in the event that you default? Or do you have any sort of clarity on the mechanism to actually get access to that funds?
Yeah, so I mean, if let's say you close a deal today in April and then you put up the 12 months P&I, if your deal is over $6 million in loan amount, and you need it the first month, then yeah, you can draw upon it. And then if you end up, let's say you draw, 25% of it, the 75% of it's still sitting up there, you can draw it after they're going to do a 6-month sort of waiting period. So you can't draw it for the first 6 months. And then you need 2 consecutive quarters of either 125 debt service, if that's where your deal was quoted, or if it was a different tier, let's say 135 debt service that your deal was quoted at, then it'll be a 135 cover. And then if your deal,
if you need to support operations, you can just submit a draw.
You can draw it.
Like you can reserves.
Yeah, I think you can draw the P&I down, the real estate tax, the insurance and replacement reserve. I've not gotten clarity exactly if you can draw that or if they just want that sitting up there just as additional reserves. And then I think after 36 months, if you don't hit your 125, which you probably have bigger problems, but I think that comes back to you probably in replacement reserves or something like that. So,
got it.
All right, some great information. We'll wrap it up. James, the Professor Rang, thanks for jumping on the call with us with JP Conklin. We'll try to have him on the next, say, 30, 45 days and kind of see where interest rates are going to and see how that can help us. And then Mr. Michael Becker, we appreciate you being on. We learn a lot by listening to both you guys, so we appreciate that. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.